If your business is profitable but still feels financially tight, this video is for you. Many companies look successful on paper but struggle every single month to stay financially comfortable. In this video, we are sharing 3 business finance mistakes that destroy profitable companies. Mistake number 1: inventory comfort fallacy. The inventory comfort fallacy happens when business owners feel safe just because they have a lot of inventory. Shelves are full, warehouse looks active, products are ready to ship. It feels like control. But financially, this comfort is often an illusion. Imagine a business that sells physical products. On paper, it looks profitable. Revenue for the year is $500,000. Gross margins look healthy. But when you check the bank account, there is constant pressure. Because $200,000 is locked inside inventory. That money is not available to pay rent, marketing, payroll, or unexpected expenses. It is sitting on shelves. Inventory may look like an asset, but cash flow-wise, it behaves like frozen money. The problem gets worse when inventory moves slowly. If products take 6 months to sell, the business is constantly paying today for money it will receive much later. This creates stress even when profits exist. Another hidden risk is outdated or excess inventory. Market demand changes, designs change, pricing pressure increases. Suddenly, inventory that once felt safe turns into discounted stock or dead stock. To fix it, first, stop measuring inventory by quantity. Measure it by speed. Ask one simple question: how many days does inventory stay before turning into cash? Second, align inventory purchases with real sales data, not optimism. If last quarter you sold 10 units per week, buying inventory for 50 units per week creates financial pressure. Third, free up trapped cash. Discount slow-moving items, bundle products, or reduce purchase volume temporarily. Cash flexibility is more valuable than perfect stock levels. Inventory should support cash flow, not compete with it. Inventory should never make a business feel relaxed. It should make a business feel alert. When too much cash sits on shelves, flexibility disappears. The business becomes slower to react, slower to adapt, and more vulnerable to surprises. Profit on paper doesn't help if money cannot move when needed. Strong companies don't aim for full warehouses. They aim for fast-moving cash. The goal is not to own more products, but to convert products into cash efficiently. If inventory decisions are not tied to real demand and cash timing, growth will quietly turn into pressure. Inventory should support the business, not trap it. Mistake number 2: credit comfort illusion. The credit comfort illusion happens when access to credit makes a business feel financially strong. The credit line is available, the card limit is high, payments are manageable. So spending feels safe. But comfort is not the same as strength. Let's take an example. A company generates $80,000 a month in revenue, fixed costs are $50,000, profit exists. To grow faster, the business uses a credit line of $100,000. At first, everything feels fine, payments are small, growth continues. But slowly, interest adds pressure, monthly obligations increase, cash flexibility decreases. Now imagine revenue drops by just 10%. That small drop suddenly makes debt payments painful. What once felt like a growth tool becomes a survival problem. Credit creates a false sense of stability because it delays consequences. It allows businesses to avoid fixing real issues like pricing, margins, or inefficient operations. Another danger is using credit for recurring expenses. When debt supports normal operations instead of growth investments, dependency forms. At that point, the business is not using credit. Credit is using the business. To fix it, first, Treat credit as temporary support, not permanent income. If credit disappeared tomorrow, the business should still function. Second, separate growth debt from survival debt. Using credit to fund a machine that increases output is different from using credit to pay monthly expenses. Third, track debt service clearly. Know exactly how much cash leaves the business every month for repayment and interest. A strong business controls debt. A weak one gets comfortable with it. Credit feels safe until it becomes necessary. The moment a business needs credit just to function, control is already slipping. Debt should amplify strength, not hide weakness. When payments become normal and interest feels invisible, financial risk is building quietly in the background. Healthy businesses respect credit. They don't rely on it for survival. The real question is not how much credit is available, but how well the business performs without it. If credit disappeared tomorrow, would the business still stand? Mistake number 3, revenue timing mismatch. Revenue timing mismatch is one of the most dangerous finance mistakes because it hides inside profitable numbers. This happens when money comes in later, but expenses go out now. For example, a service business invoices clients today but receives payment in 60 days. At the same time, payroll, rent, software, and vendors are paid every month without delay. On paper, the business is profitable. In reality, it is constantly waiting for its own money. Let's say a company bills $100,000 in January. Expenses for January are $70,000. Profit exists. But if payment arrives in March, the business must survive February using reserves or credit. Repeat this cycle long enough, and cash stress becomes permanent. The business looks successful, but feels broke. Timing issues get worse as the company grows. More clients mean more invoices outstanding. More growth means more upfront costs. Without correction, growth actually increases risk. To fix it, first, shorten payment cycles. Even reducing terms from 60 days to 30 days can dramatically improve cash flow. Second, request partial upfront payments. Getting 30 or 40% before work starts stabilizes cash timing. Third, align expenses with collections. Delay non-essential spending during high receivable periods. Track cash timing separately from profit. Profit answers, did we make money? Cash timing answers, do we have money? Healthy businesses manage both. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.